In the fast-paced world of Forex trading, understanding price movements is crucial for success. Traders are constantly searching for effective tools and strategies to gain an edge in the market. While traditional candlestick charts are widely used, an alternative charting method called Renko charts is gaining popularity. Renko charts offer a unique perspective on price action, helping traders identify trends, spot potential reversals, and make more informed trading decisions. Originating in Japan, the word Renko comes from the Japanese word renga, meaning brick. True to their name, Renko charts display price movements as a series of bricks, filtering out the noise of minor fluctuations. Unlike candlestick charts, which factor in both price and time, Renko charts focus solely on price movements. This unique characteristic makes Renko charts an invaluable tool for traders looking to cut through the clutter and gain a clearer view of market trends. By simplifying price action and emphasizing significant movements, Renko charts provide traders with a unique perspective that can be particularly useful in volatile markets. Whether you are a seasoned trader or just starting, understanding the power of Renko charts can be a valuable addition to your trading arsenal. While both Renko and candlestick charts aim to visualize price movements, they differ significantly in their approach and the information they convey. Traditional candlestick charts display price data within a specific time frame, typically represented by a single candlestick. Each candlestick provides information on the opening, closing, high, and low prices within that time frame. In contrast, Renko charts disregard the element of time and focus solely on price changes. A new brick is drawn on the chart only when the price moves a predetermined amount, known as the box size. If the price moves in favor of the trend, a new brick is added in the same direction. If the price reverses and moves against the trend by a specified amount, a new brick is drawn in the opposite direction, creating a distinctive up and down pattern. This unique characteristic of Renko charts filters out minor price fluctuations that can create confusion and false signals on candlestick charts. By focusing only on significant price movements, Renko charts offer a cleaner and more concise view of the market trend, making it easier to identify key support and resistance levels. The absence of time on Renko charts allows traders to focus solely on the price action, potentially leading to more objective trading decisions based on pure price movements. The effectiveness of the Renko strategy lies in understanding and leveraging its core features. At the heart of this strategy is the concept of bricks and box sizes. As mentioned earlier, Renko charts display price movements as a series of bricks, with each brick representing a predefined price movement. The box size determines the amount of price change required to draw a new brick. Choosing the right box size is crucial when using Renko charts. A smaller box size will result in more bricks and a more sensitive chart, capturing minor price fluctuations. Conversely, a larger box size will create fewer bricks and a less sensitive chart, filtering out more noise and focusing on significant price movements. Another key feature of the Renko strategy is its independence from time frames. Unlike candlestick charts, which are bound by specific time intervals, Renko charts are not limited by time. This means that a Renko chart will only print a new brick when the price moves by the predetermined box size, regardless of how long it takes. This feature allows traders to analyze price action objectively, focusing solely on the magnitude of price movements rather than being influenced by the passage of time. While Renko charts provide a clear and concise view of price action, combining them with technical indicators can further enhance their effectiveness and provide valuable insights into market dynamics. Popular indicators like the Relative Strength Index, RSI, Commodity Channel Index, CCI, and Exponential Moving Averages, EMA, can be seamlessly integrated with Renko charts to confirm trends, identify potential overbought or oversold conditions, and generate trading signals. The RSI is a momentum oscillator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. When used in conjunction with Renko charts, the RSI can help traders identify potential trend reversals or confirm the strength of an existing trend. For example, an RSI reading above 70 on a Renko chart might suggest an overbought market, while a reading below 30 could indicate oversold conditions. The CCI, another momentum oscillator, measures the current price level relative to an average price level over a given period. Similar to the RSI, the CCI can be used to identify overbought and oversold conditions, but it also helps traders spot potential trend changes and breakouts. On a Renko chart, a CCI reading above 100 might suggest an overbought market, while a reading below -100 could indicate oversold conditions. Finally, EMAs, which are trend-following indicators, can be applied to Renko charts to identify the prevailing trend direction and potential support and resistance levels. For instance, a rising EMA on a Renko chart suggests an uptrend, while a falling EMA indicates a downtrend. By combining the insights derived from Renko charts with the signals generated by these indicators, traders can make more informed trading decisions and potentially improve their trading accuracy.